A little clue there about our next guest joining me for our next panel, where we're going to look at risk and regulation, how to maintain stability, how to protect consumers without, and this is the challenge, without stifling growth and innovation. The big question, what lessons can we learn from all over the world? So to do that, please let me introduce my next panel. Next to me, Ashish Chauhan, Managing Director and Chief Executive of the National Stock Exchange. Tushar, Thakker, CMD at Peraj Insurance. And also joining us online, as you can see, Charlie Walker, Deputy Chief Executive of the London Stock Exchange. Welcome to you all, and Charlie, good to see you there in London. Thank you for being with us. What I'll do, I'll start with Ashish and Charlie to set a little scene of where we are now, and then I'll bring in Tushar in just a moment. But Ashish, give me a sense of the challenge, the fine line that you have to tread between protecting consumers and regulation without stifling innovation, because it is a fine line and one that you have to get right.
In a way, in finance, we call something innovation need not be innovation. Once, I think Mahathir Mohamad in Kuala Lumpur took me aside on an event like this and said, the only innovation financial industry has done is ATM in last 50 years. Of course, after that, UPI has come in India. But basically, we may continue to pretend that we are doing innovations, but finally, when you deal with people's money, because banks or stock markets or even insurance, they deal with people's money where the money has to come back with interest or whatever the intended benefits. And that's where it's important to protect the interest of the investors, and that's where the consumers, and the innovation has to be within the purview of the investor protection. And that's how India has been managing its regulatory stance compared to the rest of the world, where sometimes you run ahead on creating newer acronyms, they look the same. It's just that we want to confuse the rest of the people so that we can keep on making more money. But basically, idea is to keep simple, stupid stuff and keep on innovating to protect investor interest first, and within that, whatever innovations sort of possible, we should allow.
Charlie, let me bring you in London. I mean, that is the challenge for all regulators, but even for exchanges too. You know, how do you adapt to changing innovations to make sure that consumers, investors are safeguarded in what they do?
Yeah, and thank you very much for having me, and good afternoon, everyone. I think, we think democratization of financial services is critically important, certainly in the UK, but I think this is true around the world. Individuals are being asked to take more responsibility for their own financial futures. We've seen that certainly in the UK with the demise of defined benefit pension schemes, for instance. So individual investors being asked to essentially manage their own financial futures. And if they're going to do that, then they need access to the information and they need access to the markets in order to be able to discharge that responsibility. So the question is, how do you do that in a responsible way? I think it's a really interesting time for capital markets globally. I'm sure we'll come and talk about some of these things, but you've got a few themes, and these are at times opposing with one another. So you've got digital technologies that's allowing individuals to access more asset classes. So I think crypto in more ways, think through apps, for instance, and in more countries, think cross-border. And at the same time, regulations historically have often tried to protect retail investors, understandably and rightly, but at times, probably unintentionally, has led to just their exclusion from markets. And so how do you reweight that a little bit? And then we've also seen the rise of private markets, which are clearly more challenging for individuals to access. And so again, a big focus in the UK at the moment is how do you make sure that public markets are relatively attractive to private markets? So if you think about a regulatory perspective, they've got to deal with new asset classes, new technologies, and the rise of new markets, while trying to strike this balance between how do you allow retail investors to participate in markets while ensure that there are the appropriate safeguards and protections. And I think what I'm really pleased to see, or what we're really pleased to see, is, I think in the UK, but I think this is true elsewhere as well, there is a real push with regulators to have that open dialogue, and to try to make sure that balance is properly struck.
In this event is how technology is changing so much that we take for granted as well. And it's technology that's permitted more access to financial markets and to financial services. But there's always a danger, isn't there, that technology is one step ahead of regulation.
There is, and I think there's also a challenge that regulators have, which is how do you try to allow innovation to occur in a safe way, and with limited capacity and resources, how do you make sure that you're using them in the right way? So if every single time a new opportunity or innovation or market crops up, there's immediately regulation around it, is that actually sustainable? Are they able to commit the resources they need to it? Or do you need to allow innovation to happen in small ways? And then when you can see what the markets develop, how they develop, what impact they're having, then you sort of start to regulate that. And you're seeing that in markets at the moment, crypto being a sort of prime example of that. I think that's kind of inevitable. There is just a limit to regulatory capacity that exists in I think countries around the world, certainly in the UK. And so I think that's probably a theme that we'll continue to see.
Charlie raised the point there about this is about everybody working together, and I wonder though whether there is enough collaboration between regulators and those being regulated, so the financial institutions, or do you get a sense that it's just a bit of a standoff? That it's kind of, don't come, trying to regulate me because I want to offer all these amazing services. How does that relationship work?
In a way, in India, there has been, the regulator is of new origin. They are around 35 years old. And in a way, they were the harbinger of automation in India. They pushed for screen-based trading. They pushed for real-time risk management. They even pushed for the mobile trading. Or in some ways, the Indian regulators are more engineering since they're engineers compared to anything else like T+1 settlements. World is talking, India is walking. India achieved T+1 in 2023 January fully. And similarly today, if you look at India's overall framework, it's pretty much the lowest cost markets for people for transacting in stock markets, and the numbers are staggering. Today, I have 90 million unique investors registered with me, 180 million accounts. And on a good day, they would send me 17 billion orders in 6 hours and 15 minutes. And they would trade 250 million trades. That's around 40% of all trades in the world on that day, right? So for me, whatever has happened in terms of the regulatory stance or the way the consultation happens in India, it's very, very inclusive. Every part of the market is included in all sorts of consultation. Every day, consultation continues in every aspect of it. But finally, the regulator has to take a call that whatever we do has to be in the interest of investors and not in the interest of the players. And that's where basically Indian regulatory stance differs compared to rest of the world in many ways. And the results are for everyone to see, because today, when NSE started as the first screen-based automated exchange in the world, which became successful in 1994, after that, everyone else became automated. And that time, India had like 2 million investors. Today, we have like 50 times more. Our market capitalization was around $250 billion. Today, it's close to $5 trillion. It's fourth largest in the world. And usually, there is a perception that in a lower per capita income country, where people can't save because most of the money they use is for the consumption, and they can't save. And if they save, they don't want to save in very abstract things like companies. But India, with lower per capita income situation, is now the fourth largest market in terms of the market cap, largest market in terms of number of trades. And it has proved all the economic theories wrong because of very strong regulation, which are largely for investor protection. And that's how I see that many times. And our participants have come to know that this is how it's going to be. They also come back saying, this is going to increase risk. Why don't you allow us to actually take more margins, which is not usually the case in other parts. And the second slight difference is in most parts of the Europe and US, the exchanges have become actually participants. They have become commercial entities. Whereas in India, the exchanges are still the regulators. And so when you ask what is the regulatory stance, I am also a regulator. I regulate as a frontline regulator between brokers and companies both. And the mainline regulator actually comes out with regulations we implement. So in some ways, we are very cooperative, very consultative, but our mainline regulator also is very cooperative and consultative.
Tushar, let me bring you in here because Ashish there was talking about the players. You're a player in the financial services industry. How would you characterize your relationship with the regulation?
How do you?
How would you characterize your relationship with regulation?
Characterize
The
regulatory stance.
See, in India, insurance has been a heavily regulated market, and at heart of this whole is to protect the policyholder interest above all. And recent past, regulator has shown a clear intent to deregularize as much as possible while making sure that they have a keen eye and observe the financial stability of all stakeholders, that is insurers, brokers, and all the other intermediary and supplementary services providers. They are very keen to ensure the quality of players that come into the market. Recently, you have seen that they have opened up the investment into the insurance industry by allowing 100% investment in insurance companies in India and up to 74% in the broking industry. So I think the regulator now, while adopting a cautious line to ensure financial stability, is opening up to the idea of a more liberalized market where players have more freedom to bring technology, bring new products and bring more value to the customers.
Charlie, let me bring you back in here because, by its very nature, financial services is cross-border, isn't it? And I wonder how much collaboration there is around the world on regulation. Is there a coordinated, joined-up global approach, or is everyone just doing their own thing?
It's interesting because I think capital markets are cross-border and they've become much more globalized. Obviously, with you've seen globalization on the buy side, companies becoming more international. But you're also seeing, and it depends on the asset class, you're also seeing, I think, countries seeing their domestic capital markets as being critical to their own economic future and sovereignty. And that's certainly a theme that we've been seeing around the world. So countries wanting their domestic companies to list on domestic exchanges, be regulated by domestic regulators. And that's a change. That wasn't the case 10, 20 years ago as such. And you've also seen the rise of stock exchanges around the world who are able and capable of hosting those companies. And so what we're seeing now is more desire to collaborate. How do countries collaborate? How do they build capital markets connectivity between them so that the benefits of countries being able to host their domestic companies that are critical to their economies and have the regulations governing those companies continue, but also allow companies to access international capital markets and investors that they may not be able to access just domestically. So it'll be an interesting time. It feels like capital markets are developing or on a slightly different course, should we say, than they were 10 or 20 years ago, where it was all about globalization. It feels to us a little bit more now like it's countries looking to encourage, develop, protect domestic capital markets, and then selectively build capital market links with international markets. That's certainly true on the equity side. It's probably slightly less true on the fixed income side.
Really useful, and actually so interested in your response to that, because how does India compare itself to the rest of the world, do you think?
In a way, I consider the markets part of the finance as the most international of any activity mankind does. Right. For me, money moves like water. Wherever there is least resistance, you won't even know that it has moved. And money moves very fast, and that's where the markets are amongst the most internationalized activities. And we have two layers of collaboration internationally. One is what we call IOSCO, which is sort of a group of the regulators. They meet pretty much every month and try to reconcile, rationalize their policies across the entire world markets, especially the top markets. But they are a group of probably 150 jurisdictions. And the next layer is what we call World Federation of Exchanges. I sit on the board of the World Federation of Exchanges. And that's basically the stock exchanges across the world. They get together and try to rationalize their activities. At the same time, each country is sovereign, and they have their own peculiarities based on the markets, as you said. And so we need to also be compliant with the local regulations. But usually, broadly speaking, the regulations are very comparable across the world in terms of user-facing, especially the investor-facing regulations, so that wherever the buy side wants to do things, they end up meeting similar standards, even for clearing, settlement, risk management, back offices, broadly. Even we have worked over last 30, 40 years on the messaging across our computers using ISO standards or FIC standards, so that everyone, wherever they want to trade on any exchange in the world, any clearing house they want to clear through, any settlement depositories they want to work through, or a bank, we have broadly similar standards so that they don't get confused.
And Tushar, we talked about how so many industries are being transformed by tech, financial services no exception. What has technology changed for your sector? Because you talk about it being on the verge of a big boom. What would that look like? What is that boom?
Well, I think a lot will come up in coming years. As I said, that the regulator is looking for, liberalizing the industry by allowing new insurers to come in, new brokers to come in. And until now, it was a very protected market where you could only have certain limited products and services defined and approved by. You will now see that there could be more product innovation, tailor-made covers. You could see new players bring in more technology, more knowledge. So what we would see is a lot more. Today, the market is growing at, say, about 17%. Insurance market, but I think that this growth could be a lot bigger in coming years, and even non-industry players can kind of participate in this by, if you are selling automobiles, you can sell insurance. If you're selling handphones, you can sell insurance with it. So non-industry players are also contributing and can contribute a lot more to the growth. And we see that trend when more and more organizations wanting to bundle the product, so it becomes a revenue generation, becomes a one-stop shop for the product selling. So you will see more products come in, you will see more people, more companies participating in this growth story. You will see that the regulator is very keen to support the development of more penetration in the market.
It's been really great to talk to you. Time is really tight, as always, at these events, but it's fantastic to get an overview there of what that means. Ladies and gents, please thank Charlie Walker joining us there in London, Tushar Thakker, and also with us here, Ashish Chauhan. Thank you so much.
Thank you.
Lovely to see you. Thank you.
Thank you very much.